And so this is the final talk before we wrap up this afternoon's proceedings. And so please welcome to the stage Charlene Mesle, who's the Director for ESG and Climate Consultant at Morningstar. It's easier to go around that way. And the title is Living Up to Labels and Regulation, Strategies for Addressing Companies from High-Impact Climate Sectors. So please welcome Charlene to the stage.
Hello, everyone, and thank you, LuxFlag, for having me today. I would like to discuss with you an interesting analysis we have done based on the data from our low carbon transition rating that highlight how investors, a portfolio manager, so you, could address in the short-term horizon the companies from high-impact climate sector in their responsible investment strategy. So I think good compliment from what we have just heard from Constance from Société Générale. First, to echo this previous panel, it's interesting to see and to note that the issue of climate transition, so managing the transition climate risk, is becoming more central, such as material, as we call just before. The shift operated clearly this year, and we are seeing an acceleration in the take-up of the subject by regulatory bodies, labels, and investors, such as asset owners. The focus now is much more on the journey than rather the destination by 2050, and how we can concretely finance the transition. There is also a shift in focus on portfolio decarbonization to real-world emission reduction. So this means less focus on divestment and more on investing in the right places to drive change. On the screen, you see from our latest asset owner survey that most of them say environmental factors have become more materials in the past year, and specifically, the transition to the net zero emission represents the environmental factor most material to decision making, followed by energy management. And new to the list of the top 3 issues in 2024 is water and wastewater management. So ice temperature rise, so too does the urgency to decarbonize the global economy. It's why sustainable finance standard setting bodies are becoming increasingly stringent on their decarbonization criteria. So anticipating the risk of further climate regulation, many investors and asset managers are working to decarbonize their portfolio and reduce the impact of their investment on global warming. So climate transition strategy, which tilt toward companies that are better prepared for the transition to a low-carbon economy, grew up by 25% in 2023. But the central question is how we finance the transition effectively. One practical approach to reaching this goal is to concentrate effort on the sectors that are emitting the highest level of greenhouse gas. This approach is supported by several sustainable finance standards, including the EU SFDR, the EU Paris PAB, and Climate Transition CTB benchmark, and as well the latest ISMA fund naming rules. So this standard recommend excluding certain sectors from investment, for example, the thermal coal and certain fossil fuel. But however, a focus on portfolio decarbonization just based on divestment creates some problem. So first, divesting from high-emitting assets reduces emission at portfolio level, but not in the real economy, and removes capital from where impact is needed the most. Secondly, divesting from key sector can make it difficult for asset manager to manage the portfolio in a large investment universe. And finally, it limits ability to benefit from companies transitioning their business model. And also, even with thermal coal and certain fossil fuel sector excluding from investment, plenty of carbon-intensive sectors remain, such as we mentioned previously, agriculture, manufacturing, construction, water supply, and real estate, which require ambitious carbon emission reduction plan. So for those sectors, company and their investor, we need to find other strategy than exclusion to reduce emission and align with the 1.5 degrees commitment of the Paris Agreement. Transition finance is really about supporting entities to achieve a net zero and not simply financing transitional activities. So in order to allocate capital aligned with the transition to a low carbon economy, investors need to incorporate climate consideration in all steps of their investment process. And for these companies with high CO2 emission, the challenge will be to ensure the credibility of their transition plan. This means evaluate commitment of the company to decarbonization, the concrete action the company is doing to transition, to pivot the business model, the credibility of this plan, the governance, and all other mechanisms in place to ensure it is meeting its objective. So this is what we can call the AAA transition plan framework, ambition, action, accountability. This priority is even more urgent now that companies in high-impact climate sector make up more than 60% of the global economy. That's why portfolio manager cannot avoid this part of the market. And as shown in the graph on screen, in Europe, high-impact climate sector companies make up about 70% of the total market capitalization. In the United States and Canada, it's less than 60% of the economy that falls in high-impact climate sector category, likely because of the large presence of the financial sector, as well as software and internet services companies from technology sector. Latin America and Caribbean also have a large focus on financial sectors companies. So for assessing high-impact climate sector and their positioning toward the objective of 1.5 degree, we have used data from our low carbon transition rating solution. So to assess in particular the credibility of the company climate transition plan. So the low carbon transition rating assesses companies' transition plan and progress toward stated GHG reduction commitment by evaluating the quality and ambition of their GHG reduction target, along with existing trend of carbon emission and forward-looking investment plan. So as of today, based on our global research universe, there are no company with a credible climate transition strategy that is aligned with the Paris Agreement, so below 1.5 degree. So the universe is about 12,000 companies, and we do not have anyone at or below 1.5 degree. All sector covered. But although most companies in our research universe are misaligned, we do find important differences in the quality of their climate transition plan. So in the graph, we see that 14.3% of companies fall under the moderately misaligned category, so meaning between 1.5 and 2 degrees. That is still better than those companies that are significantly highly or severely misaligned. And while companies in high climate emitting sector have a greater degree of misalignment with the Paris Agreement compared to the other sector, the difference is small, specifically in the significantly misaligned category. So for environmental and transition funds, managers face a clear challenge And if these investors are serious about the target, one way to reach the threshold is to strengthen their engagement effort with this high climate sector company in their portfolio. So achieving real-world positive outcomes through direct and intense engagement with activity is not guaranteed. But many fund manager employ engagement strategy, but to really move a company in a more positive direction require extensive resources. So investors need to be very precise in where they focus their engagement effort to see meaningful progress among portfolio companies. So when zooming in the specific sector within the high-impact climate category, we note that sectors with the lowest proportion of highly or severely misaligned companies include textile, luxury apparel, real estate development, and precious metal mining sector. So for tobacco companies, they would be phased out under most responsible investment standard. So engaging with tobacco company would be irrelevant, except for the few companies that are investing substantially to transition to an alternative sector. On the other hand, the sector that has a larger share of companies that are severely misaligned and will require more effort to bring into alignment with the Paris Agreement include, with no big surprise, coal, oil and gas, motorcycle, shipping, and automobile. So same than tobacco, coals company, and some oil and gas producer will likely already be being screened out by responsible investment policy. So for fund manager, focusing engagement on companies with the semiconductor, design, manufacturing, luxury apparel, and real estate industry would enable them to move more of their investment toward credible transition plan by 2026 already. As seen on the screen, these are the high-impact climate sector with the highest proportion of their market capitalization within the moderately or significantly misaligned category, meaning that they are closer to becoming fully aligned to a 1.5-degree scenario. And for engagement, so at Morningstar Sustainalytics, we do have a specific net zero transition engagement program that supports progress toward investor-led decarbonization target through direct and constructive dialogue with companies across sectors that have the most climate impact. So collaborative engagement through either program like we offer at Sustainalytics or via a public coalition could help investors to achieve positive results with companies, making them investable for their transition funds. For the last part of this presentation, I wanted to give you some additional insight on our low carbon transition rating solution, on which the graph you have so just before are based on. So the Morningstar Sustainalytics Low Carbon Transition Rating provide a top-level implied temperature rise and the value at risk, a climate value at risk. So assessing company on their current alignment to a net zero pathway. The ratings are supported by a robust research and a transparent data set, so included annual expected emission trajectory for different climate change scenarios mentioned just before. And the biggest added value of the research is that we assess specifically what we call the managed emission, based on the credibility and the robustness of transition plan of company. So we do assess the quality and ambition of their GHG reduction target, the short-term investment plan, climate governance, product decarbonization strategy, and GHG emission reduction policy for the supply chain. So the solution assess scope 1, 2, but also scope 3, upstream, downstream. And you can compare expected emission to multiple climate scenarios as required by the regulation. So this comprehensive assessment of management action, rather than just use the company's stated emission, allow to identify the company that are the best prepared to align their transition to a net zero pathway. And this conclusion of the research is also super helpful to engage structurally with the company you are invested in. And at Morningstar Sustainalytics, as I mentioned, the low carbon transition rating research provide deep insight to target company with specific criteria that support effective engagement and KPI tracking. Because in the engagement, the biggest challenge we see for the portfolio manager is to put a clear KPI in place and create reporting on their engagement success. Specifically, the solution will help to identify company with insufficient disclosure or weak management, quantify financial impact of inaction through the value at risk, identify which scope of emission require most improvement in management, and identify specific area for improvement and industry best practices to follow. So, as we just heard before, every day we are witness of the deleterious but anticipated effect of climate change. So we have no choice but act. And for the financial sector, the task is clear: to mobilize, with the support of public authorities, labels, the necessary financing of the transition. So I hope this couple of slides gives you a clearer idea of the tool you have on hand to achieve this, and particularly going beyond exclusion strategy, but adopt a sector differentiated strategy and engagement with companies. So direct dialogue with company, which is the only truly credible investment approach for carbon. Thank you for your time.
Thank you.